Hello, everyone, and welcome to the Behind the Market Structure. I am David Easthope. I'm the head of FinTech on the Market Structure and Technology team at Coalition Greenwich, and I'm very pleased today to be talking about digital assets, and I'm joined today by Michael Moro, the CEO of Genesis. Michael, welcome.
Good morning, David. Nice to be here.
Great, excellent. Really glad to have you. And one thing that I'm really excited about today is when we're talking about digital assets is to have someone who's been there from pretty much the beginning. You've been the CEO since 2016, which is excellent, but you started even earlier than that back in 2013. And it'd be very interesting to delve into that. I'm really excited to go into that. So, without further ado, why don't you just tell us how you got started in the industry, how you've taken Genesis to where it is today, and what got you interested in crypto?
So the journey really started for us in 2012. So even a year kind of ahead of our launching our business, when the CEO and founder of the company at the time, Barry Silbert, he himself got interested in Bitcoin, went down kind of the Bitcoin rabbit hole in early 2012. And kind of came out the other side, as a complete believer, evangelist in what it potentially could be. The company was focused at the time on trading illiquid financial assets. So this is 2012, so just 4 years removed from the financial crisis, and we were trading toxic assets that belong to the banks, got asset-backed securities and some of the equity derivative products that were out there, and CDOs and things of that sort. And Bitcoin at the time was an illiquid, off-the-run, hard-to-value thing, which fit very neatly into everything else that we were kind of trading at the time. And so said, hey, Bitcoin might be kind of the birth of a brand new asset class. It might be sort of digital gold element, or it could go to zero, right? So it was a very sort of binary outcome here of it could be better money, better store value, or it could be just a technological failure experiment, right? That until go to zero. But we decided in 2013 to just kind of take a shot on kind of Bitcoin being a thing. And we, as an SEC and FINRA registered broker-dealer, were really trying to get institutions interested because Bitcoin at the time was incredibly sort of a retail-focused, grassroots type of an effort. And we said, hey, for this asset class to grow, let's get institutions involved. But that's how early we really were in trying to be the first over-the-counter institutional trading desk of Bitcoin effectively in the world.
Mm-hmm. Yeah, I'm sure that things were a little different than they are today. You've got, a wide swath of institutional offerings out there now, and Coalition Greenwich, our research shows that these institutions now are kind of taking the reins of the industry and really, aren't going away. And it seems like that's probably something to keep in mind when we talk about these kind of recent bouts of market volatility. Like you've been through many of these cycles. Or multiple. It doesn't seem like institutions are really going away. We see lots of crypto hedge funds, traditional hedge funds taking interest here. So maybe you could help us put some of this volatility in perspective.
So back in 2013, as I was saying, when we first started the asset class, spot trading, sort of cash trading of Bitcoin was all that there really was. And while we believed that eventually when the institutional investors enter the marketplace, that they would expect the same products and services that they get in other markets, we would have been way too early to try to introduce, lending, borrowing, derivatives in 2013, right? So we really kind of believed in sequencing the launch of various products and services as more and more institutions ultimately enter the space. We certainly didn't want to put the cart before the horse as we think about growing our business. But Bitcoin still remains incredibly nascent, and sort of kind of digital assets and crypto in general, I think, is still very, very early. The market structure looks very, very different in kind of the crypto world than what we see in the traditional world. And David, you and I were chatting about this before we got here, but this is a 24/7 market. This is there is no sort of off-market hours to like cool off, trading activity, both kind of up and down. So volatility is still there, certainly higher than what we see in traditional markets. And I think it'll continue, but I think that's just because we're so early in what we're building, and we're not close to the mature state, right, of what kind of from a market cap and market infrastructure perspective, we're not there at what kind of the final product is. But if we were closer to the final product, like a lot of people wouldn't be calling Bitcoin a speculative asset, right? I think the opportunities to earn, 10x or whatever from here exists because we still have a ton of room to ultimately kind of grow. But having said that, though, volatility is actually coming down over the years. Certainly over the 9 years that we've been operating, we've seen, kind of volatility coming down, and certainly the introduction of products like the CME futures product has certainly helped so that not every position is ultimately like expressed directly in the spot market. And frankly, too, as more and more institutions have entered this space, institutions are more thoughtful. They have a plan when they get into Bitcoin as to how they want to accumulate a position and the exit, depending on, hey, we're up 10%, what do we do? We're up 20%, what do we do? We're down 30%, what do we do? They have a strategy as to how they want to play this. Retail, which was the dominant share, right, of the marketplace, they're far more emotional. They probably bought too much on the way up, and then they're afraid of like losing their house potentially on the way down, right? And so, kind of having more thoughtful, strategic investors in the institutions have actually certainly helped to kind of dampen that volatility.
Mm-hmm. Yeah, I mean, you mentioned some of the unique characteristics of this asset class, right? So it's always kind of the first conversation you have with anyone when they're moving from another asset class into this one. What makes it unique? So you've got that, bearer asset. You've got, you mentioned 24/7 markets. Custody is a whole nother ballgame, right? Security. And we can get into the regulatory stuff of KYC, AML, and all of that. But I think that's probably where we should start, right? So there's this plumbing, right? There's this ability to support buy and hold, right? And it has to start with. So maybe you could talk a little bit about how you built that, how you got allowed other institutions to access spot, and what sort of things you offer today that can enable institutions to get into the space.
So we were really focused on block trading at the very beginning. We felt because, and as I said earlier, retail was 100% of the market effectively when we got into the market, and and institutions have only come in the last few years, which from a market like construction perspective is very backwards. In a lot of other asset classes, institutions kind of get in first, and then they figure out how to distribute and kind of get retail investors involved. And it really kind of developed kind of retail first for a very long time. And we felt that because that's how the market was constructed, that retail was very well covered. And in terms, obviously, kind of firms like Coinbase do a very good job of like covering kind of the retail mass consumer market. For us, we were focused really on helping institutions build like significant positions. So we had minimum trade sizes early on, right? And to kind of limit retail participation. And back then, I think our first like a minimum trade size was about $25,000. So you had to be an accredited type of investor to kind of and which certainly helped from a regulatory perspective. And now today, like to talk about where we were then, the 25K minimum, you now actually have to have a minimum net worth, I think, of $10 million to become a Genesis client. So you can tell, so just from kind of that, as to how far we've kind of come in terms of institutional participation. But like we're still on the cash side, on the spot Bitcoin side, and certainly not other cryptos. Bitcoin was the only thing in 2013, really. But we have hundreds and hundreds of different tokens today. We certainly help clients build and accumulate whatever digital currency that they choose. They are able to then take that and custody that with us via like cold storage solutions and to make sure that we are able to kind of keep the funds safe on behalf of our clients. And then we also offer kind of the borrowing and lending option. of being able to take the Bitcoins that you purchased and then lend them out for additional yield, or take those Bitcoins and use that as collateral to borrow US dollars. And so we're starting to kind of see sort of the birth of a reverse repo type of market that we see in traditional markets. And OTC derivatives as well has really sort of taken off in the last couple of years. And so today, whereas we only had spot trading, 9 years ago, there's now, puts and calls, people doing forward transactions, people are doing, obviously the futures market is very active. There's now a funding, lending market, and the custody business. So we're certainly kind of getting closer, building piece by piece as to some of the products that you see in equities, for instance.
Yeah, I mean, it's worth kind of calling it out, right? So you're one of very few firms that offer that full service, right?
Mm-hmm.
For custody, execution, derivatives, and then borrow and lend, right? And all the kind of trade desk support, market color, market structure knowledge, and all the stuff that we really love and focus on. Like you have all of that, and I think that's worth mentioning, especially since one of the things about this space that again is unique, we keep harping on these things, is you don't see the traditional brands and banks that you recognize for prime brokerage. Although we see those banks kind of reassessing that whole business. It's certainly a major trend in 2022 and beyond is what is a prime broker? What spaces should they be in? What do they need to offer leverage and market access to various products? We see those banks kind of offering selective services, and you seem to offer the full suite. Tell us a little about that journey. I mean, did you build that? Did you partner? Like, how did you actually build that full suite together to offer to institutions?
So I mentioned this earlier, but we really wanted to be thoughtful about how we grew the Genesis business. And launching a derivatives business in 2013 would have been way too early, right? Like no one was in the space. We were trying to get institutional investor number one, right, in the door as it relates to kind of the crypto market. For the first 4 years of our business, all we really did was to focus on kind of the spot trading. The 2017 bull market really kind of changed the game as far as institutions taking notice of the asset class. And while the 2017 bull market was really kind of dominated by like the ICOs, kind of the retail fueled ICO mania of now, 5 years ago, it started, crypto, Bitcoin started to enter the headlines. And so we started to see coverage in the Journal and on CNBC and other like major news outlets really kind of for the first time. And I think that's when institutions were like, oh, what is this thing? Like, oh, yeah, I remember hearing about this, in 2013 by those crazy Genesis guys. And they're like, oh, this now looks interesting to us. As kind of the market cap got bigger, prices kind of went up, and, Bitcoin kind of went from sub 1K to like 20K, right, in that 2017 bull market. So we launched our lending and borrowing business in 2018. Largely because we felt more and more institutions were now like paying attention to the asset class, and there was more involvement, and people were like, hey, can I lend this out? There was no spot borrow market in Bitcoin at the time, or in crypto at all, when we launched our lending business in 2018. Whereas obviously lots of people can borrow stocks to short, right, kind of in the equities market. You didn't have the kind of the equivalent of that in Bitcoin, and so we said, okay, let's launch our lending business. We did this in March of 2018, and 2018, as you remember, was really like a huge bear market for the price. So 2017 was the boom, 2018 was the bust, and we were really kind of giving client institutions the ability to like short spot Bitcoin and other cryptos for the very first time. And so that was coincidental. I wish I could say I timed the launch of the lending business at the start of a bear market. But that really kind of helped, I think, to create an avenue for people to be able to express a view either on the short side or to hedge an exposure that they might have elsewhere. On top of that, 2 years ago, we acquired our custody business. So we acquired a business in the UK that is now kind of the Genesis custody business to be able to kind of keep and hold assets for third parties. And then that's also when we launched our derivatives business as well. So, all of these businesses, I think we were trying to be, sequential and thoughtful and execute when it made sense, when there was a product market fit. And that's how we put together kind of the prime services suite that Genesis offers, sort of in a one-stop shop that a lot of investors sort of get in other markets.
Yeah. No, it's interesting to see how you built that platform, that suite that you mentioned, and kind of plugged in the areas that institutions are used to getting services and building out products and building out sales organizations. You know, one thing you mentioned was UK, right? Which got me thinking about licensing and regulatory. So obviously you are, Genesis has an approach around regulation that is thoughtful, right? You go out and get the licensing. You take the time to build and educate. So maybe you can talk a little bit about that idea about regulation and how you've approached that, licensing, how you've built out the trust.
So as mentioned, back 9 years ago when we first started doing this, we had a broker dealer. We chose to trade Bitcoin through our broker dealer. Now, Bitcoin is not a security, and as of this morning, and we certainly, but we felt like for institutions to get involved in the asset class, they wanted and needed to face a regulated counterparty. And so we felt that it was important that they face the broker dealer in the very same way that they face them for other, for bonds and stocks and other things like that. So we said, okay, let's continue to trade it through our broker dealer. So that entity, the kind of the spot trading entity, is still an SEC FIN registered broker dealer. It's also the entity that has the BIT license with the New York State Department of Financial Services. On top of that, the UK custody business is registered with the FCA, and so there's certainly regulatory oversight put on by the government over the UK. And we have an office and a business out in Singapore, which is currently applying for that application with the Monetary Authority of Singapore to get properly licensed there. And then we will also be applying for what's called a Class F license in Bermuda to help kind of grow our derivatives, like an offshore derivatives trading business. In the US, as of now, there is no federal regulator for kind of Bitcoin and kind of crypto in general. There appears to be a tug of war between the SEC and the CFTC as to who has ultimate oversight. But because we don't have a federal regulator, we have to kind of follow all of 50 state guidelines. And so tracking state by state regulation as it relates to kind of the crypto asset class, as you might imagine, is a lot for businesses and service providers to handle. But we're hopeful that we'll get a federal regulator in kind of overseeing kind of crypto for sensible regulation. And I think that'll continue to bring institutional investors a lot more comfortable around the asset class.
Yeah, I mean, it always feels a little like people in crypto are, because of this US issue, right? Without the federal guidance, it's like they're building a house while the building codes are changing, or could potentially change. So you have to think about how you construct your business and how you future-proof it. And it seems like your approach has been to seek all regulatory licensing that you possibly can. And I certainly noticed that there are other firms that do that as well, but there's certainly some that take a different approach, right? Which may or may not be productive in the dialogue. Now, one thing you definitely mentioned derivatives, but I want to drill down a little into borrow, right? So what types of firms are borrowing? What are they borrowing for? I know your lending book is quite significant. Maybe you can talk a little bit about the borrow side.
Sure. So we believe, and numbers are hard to kind of come by in the crypto market, but we believe that we run the largest lending business in the crypto market. And for us, the people that borrow from Genesis are typically sort of crypto hedge funds, market makers, who are either looking to, again, from a working capital perspective, wanting to kind of borrow Bitcoin or other cryptos, or the kind of US dollar stablecoin equivalent. The hedge funds are most often putting kind of market neutral trades, trying to take advantage of sort of arbitrage opportunities between, say, the spot market and Bitcoin and kind of the futures market, say, on the CME. Or in select cases, they are going from a levered long or a levered short perspective, as they view like a short-term opportunity to kind of enhance the yield through getting additional leverage. And so it is a wide kind of variety of different like types of folks that are involved in the market. Except my view, we only work with, say, a few hundred, kind of counterparties. As big as kind of the crypto market has gotten and as institutional as it's gotten, it's still a relatively small part, percentage that I really think are like the true institutional guys, and with like good proper credit, right? It's not like a massive universe yet. That'll change hopefully over time. But we work with kind of what we think are kind of the best of the best credits in crypto. And we only work with institutions, so we stay away entirely from kind of directly facing the retail folks.
Yeah. There, I was playing with the unmute button there. Apologies for that. So one thing that you definitely hit on as well is yield, right? So for those institutions that own the underlying asset, many of them don't want to sell. Many of them have a mandate to generate additional yield on top of that. And I know you have sources for that, right? Whether it's staking, whether it's governance. Maybe talk a little bit about how you can create yield opportunities for some of your clients.
So the borrowing and lending market, as it relates to the asset class, is somewhat sort of divorced, I feel like, from kind of the interest rate market that exists in traditional finance. And it's because kind of the supply and demand dynamic of kind of the crypto market, I feel, is different than that exists in elsewhere. So take dollars for instance. Capital is very scarce in crypto. Because most of kind of the largest banks in the world are not yet lending into kind of the crypto ecosystem. But the demand for borrow of dollars especially is extremely high. And so there's a supply-demand imbalance of kind of available USD capital within the kind of the crypto marketplace. And that's why, like, you see, even in rate environments like today, relatively low still, we are, the rates in crypto kind of get into the 7, 8, 9% a year for folks that are willing to kind of lend into the crypto marketplace. And in bull markets, when that demand for dollars is much, much higher, the supply doesn't change all that much, but the demand absolutely spikes. And so within the last, call it 18 months, when we've seen kind of the big bull markets, in Bitcoin in 2020, 2021, we've seen rates kind of kick north of like, in the high teens, as we look to like try to source as much dollars as we possibly can to be able to lend out to our crypto counterparties. So that's kind of the interest rate dynamics. In addition, you mentioned kind of staking. So staking is related to not Bitcoin, but sort of proof of stake type coins, where the motivation for miners to be involved to kind of verify transactions is different kind of in the Bitcoin model versus some of the proof of stake protocols. We have an affiliate company called DCG Foundry, which actually operates the largest Bitcoin mining pool in the world. They also offer a staking service. So we partner with Foundry for folks that are custodying proof of stake assets with Genesis, to be able to earn that kind of staking reward yield through partnership with Foundry. And so that is another way for folks to be able to kind of take advantage of yield opportunities as it relates to the cryptocurrency asset class.
Right, and really speak to that full service that you offer, and including seeking out additional support for your clients, right? Where there are opportunities even within the portfolio companies, which is really interesting. Now, kind of taking a broader view, I mean, we certainly, you mentioned crypto kind of as collateral, right? And it's a volatile asset, but it can be, high quality, to some extent, collateral, which makes me think about some of these broader efforts, right, of tokenization, right? So some of the big banks, JP Morgan, others, State Street, Boney Mellon, are talking about tokenization, including money market funds. You see tokenized treasuries, 40 Act funds, right? So these starting with high quality assets that we can move around on ledgers, serve as collateral. So maybe you can kind of take us on a broader perspective of how you view those tokenization efforts and how they may impact kind of the services you offer.
Sure. So, broadly speaking, the world is moving to a more like cashless society, right? Lots of, employees, even in our Genesis, especially the younger guys, they don't carry around any cash anymore. It's all debit and credit and tapping their phones and whatnot. And in a way, it is sort of a tokenized form of passing kind of value from one party to another party. But like at the same time, tokenized securities was like a hot button topic, say a few years ago. Lots of efforts were done to try to create tokenized securities market, and that really hasn't taken off, right? I think largely because I think people felt like if you tokenize something, liquidity just like follows, and that's clearly not the case, right? Tokenizing things does not make illiquid things more liquid, but and I think largely a lot of those efforts failed as a result of thinking along those lines. At the same time, the traditional kind of securities market is likely certainly kind of moving towards a more token model. Some of the largest banks in the world are focused on kind of creating custody solutions for like tokenized securities, which very well, may look like a crypto custody service, except obviously the total addressable market of kind of the total securities market is certainly larger than just kind of the crypto market at large. And frankly, I think being able to tokenize things will make kind of settlement a lot faster. Most of our trades in crypto is T plus like 2 hours, right? It's trade date and we're done within an hour or two. I think certainly in the tokenized securities market, I think you can certainly kind of get to T plus 0 environment as we're able to like locate assets and kind of things like that much faster. And because kind of the beauty of the blockchain, we know like exactly like where everything is and and be able to kind of get market size and kind of things like that much faster. And so I do think while I don't think tokenization creates liquidity, I think tokenization certainly creates efficiency. And I think if I'm a DTCC and trying to figure out how do I play kind of the tokenized securities market, I'm trying to figure out how do I do this? How do I take custody of tokenized securities and kind of help on the settlement side? How does DVP work if it's tokenized Google shares versus like a stable coin as the ultimate settlement layer to like be able to pay for actually settle securities? And so but it is an overhaul of an entire system and infrastructure that's been built over decades. And it will certainly kind of take its time for it to play out, but I think 100% that we will within, I'm an optimist, I'll say 10 years, we will see kind of the tokenized securities market really take off.
It's really interesting. You mentioned T0, right? So we talk to many banks and many of them will tell us that some of them could move to T0 today or T plus 1 today, although they're not sure everyone else is along for the ride on that journey. And so they have this legacy modernization problem of you go first or do we all move together?
Sure.
Part of the efficiency of settlement that you mentioned of crypto assets or tokenized assets, it brings that new option in terms of that real-time settlement, right? And that becomes both an opportunity as well as a threat. It seems like that may be spurring firms along on that settlement journey things up, and so the tokenization efforts maybe they don't generate that liquidity, create that greater efficiency. And,
yeah, absolutely. Look, I think that being able to settle things at T plus 0 eliminates tying up your working capital for those 2 days. If you can like real time settle your payables or receivables at a much faster rate, I think that in itself will free up capital that can be deployed more efficiently elsewhere rather than waiting for a trade to ultimately be settled.
Yeah, it just more and more feels like while there are institutions that are on the margin tinkering with it, we feel like we're at the beginning of this journey replatforming the entire industry, right? Where you're building another building aside the building that you already have, sort of like how they built the Bay Bridge. You know, they had to build a new one, and then before they could tear the old one down. So you'll have two bridges. But I think overall, it's exciting to kind of see the journey that many of these banks are on, even more broadly across assets. And you know, my last question for you is like, what do you have a vision about, like what that re-architecture world could look like? You know, we've mentioned greater efficiency, improvement in capital efficiency, and others, but are there other benefits that you see out there going forward?
Ultimately, you know, I'd love to certainly kind of get to a world of like tokenized identity, right? Like right now, we're literally sitting in a world we have to type in a path, you know, a username and password into like every single website that there is. I'd certainly love to kind of get to a world where that information is certainly be able to tokenized and be able to kind of take that with you wherever you ultimately go. And you know, and that certainly, you know, will carry around things like property rights and title insurance, and why do I have to get insurance, and how do I know if I type in my, you know, my house to look at all the liens that exist and whether or not I'm able to buy things in a free and clear. If all of that stuff was on a blockchain, certainly a lot easier to be able to ultimately like handle. So I do think there is a little bit of like a utopia, like everything can be on a blockchain element, and I'm a skeptic of that one, certainly. But there are, I think, certainly useful applications of the blockchain technology that's kind of obviously underlying Bitcoin and other cryptocurrencies that can be useful in other markets. And frankly, that's fascinating. Like the fact that like traditional markets are going to be incorporating elements of what we thought was an experiment, right? Effectively 9 years ago when we first got in, is tremendously exciting. And I think that's also one of the reasons why I'm so confident in kind of the long-term success of the asset class. It is a brand new asset class, but it's here to stay. And even in kind of turbulent markets like this, more and more people are still getting involved, which is certainly exciting.
Absolutely, and it does feel like along that journey there are ups and downs, ebbs and flows. Some of these protocols make it, others don't. Some of the applications prove helpful, others not as planned. And I think that interesting point about identity, right? So many of the traditional financial institutions you serve don't have a solution for that yet, right? So how do you counterparties, who are you trading with at the end of the day? Do we know who that is? I mean, there's a lot of anonymity baked into the system. So how do you actually make it institutional friendly? So on that note, I think really great conversation. I really enjoyed it, Michael, and thank you so much for your perspectives. And want to mention that this will be archived and replayed. But thank you, Michael. Really appreciate your time today for the Behind the Market Structure.
Thank you, David. Appreciate you having me on.
You're welcome. Take care now.
Bye-bye.
Bye-bye.